Today, we're going to unravel a financial puzzle that honestly sounds more like a script from a heist movie. It's a story about incredibly complex rules, some really clever interpretations, and a high-stakes game where understanding a single word can literally be worth millions of dollars.
So let me just ask you this straight up. How could you possibly take a few $1,000s, put it into a retirement account for your kids, and then legally, and I mean legally, grow it to over $5 million, totally shielded from taxes? I mean, it sounds impossible, right? It seems to fly in the face of everything we know about strict contribution limits and the whole point of retirement accounts. But what if I told you a court looked at this exact situation and said, yeah, that's perfectly fine?
$5,182,314. That is the exact amount of money that ended up in 2 Roth IRAs that started with just a tiny fraction of that. And no, this isn't some hypothetical from a textbook, it's the real result from a real court case. So to figure out how this happened, we first have to understand the world that makes it possible. Okay, before we can even begin to crack this $5 million puzzle, we have to get really clear on the rules of the game. And maybe the most important rule is understanding that razor-thin line between what's considered clever and what's considered criminal.
And this right here is the whole ballgame. On one side, you have tax evasion. That's illegal. That's what lands people in jail. It's hiding income, faking documents, outright fraud. But on the other side, you have tax avoidance. And that's the art of using the law exactly as it's written to minimize what you owe. It's not about hiding anything. In fact, it's about structuring everything out in the open in the most tax-efficient way the law allows.
And this quote, which you hear a lot in tax strategy circles, really just nails the mindset. The whole philosophy here isn't about what seems fair or right. It's about what the law explicitly says you have to pay. If the tax code, in all its glorious complexity, leaves a door wide open, well, walking through it isn't seen as wrong. It's just seen as smart. It's treating the tax code less like a set of moral guidelines and more like a very, very complicated rule book for a very high-stakes game.
So what does this look like in the real world? Well, it usually comes down to 4 basic moves in the playbook. You can shift when you get your income, maybe pushing it to a later year when your tax rate is lower. You can shift who or what gets the income, moving it between yourself and a corporation. You can shift where the income is earned, say between different countries. And you can shift what the income is called, turning highly taxed regular income into lower tax capital gains. These are pretty much the foundational building blocks for every major tax strategy out there.
But these strategies aren't just ideas floating around in the air. To actually pull them off, you need specific tools, financial instruments, and legal structures that are often spelled out and allowed by the tax code itself.
Let's just take a look at a really common and totally legitimate example, something called a charitable remainder trust, or a CRT. The IRS themselves give you all the rules for these, and at its heart, it's a tool that lets someone do 2 things at once: support a charity they believe in and also get an income stream for themselves or their family. So here's the breakdown of how it works. You put some assets, say stocks or property, into a special kind of trust. That trust then pays you an income for a certain number of years. Then, when the time is up, whatever is left in the trust goes to a charity you picked out. Now, the genius part, from a tax planning view, is that you get a tax deduction right now, in the present, for that gift your charity is going to get way down the road. It's a perfect example of legal tax avoidance. You're using a tool the government sanctions to lower your tax bill today.
But what happens when people start combining these tools in ways that really push the envelope? Creating results that seem to just defy the whole spirit of the law, even if they're technically following the letter of it. This is where the story gets really, really good. It basically becomes this constant cat and mouse game between super creative tax planners and the courts, who are trying to be the referees.
And the courts aren't powerless. Over many decades, they've developed their own toolkit to fight back against what they see as abusive tax planning. Now, these aren't really laws written by Congress. They're more like principles or ways of thinking that let a judge look past all the fancy paperwork and ask a very simple question: what is really going on here? It lets them judge the substance of a deal, not just its form.
This whole idea really got its start almost a century ago with a woman named Mrs. Gregory. She wanted to get valuable stock out of her company, but she didn't want to pay the high dividend tax. So her lawyers came up with this clever plan to create a brand new temporary company, move the stock there, and then dissolve it. It technically followed all the rules, but the court basically said, come on. They ruled that this new company had no real business purpose. It existed for one reason and one reason only: to avoid taxes.
And that established this powerful idea that's still with us today: a deal has to be about more than just saving on taxes.
A few decades later, the Supreme Court took this idea even further. This time it was a guy named Mr. Netsch. He got into this bizarre deal where he was borrowing money at 3.5% interest just to buy an annuity from the very same company that only paid him 2.5%. So it was a guaranteed money loser. Why on earth would he do that? Because the interest he paid was tax deductible. The tax savings he got were so big that they turned his pre-tax loss into a huge after-tax gain. The Supreme Court looked at the whole thing and just called it a sham. It had no economic substance. It was just a fiction created purely for a tax deduction.
So now we've set the stage. On one side, you have tax planners using every legal tool they can find to avoid taxes. On the other, you have courts using these powerful doctrines to ask if these plans have a real business purpose or any economic substance. And this is the exact battleground where our $5 million puzzle plays out.
Okay, so let's walk through exactly what the Benenson family did. Step 1, pretty simple. They set up 2 Roth IRAs for their sons. Put a few $1,000s in them. Step 2, and this is where it gets really clever, those little IRAs buy a special type of company, a DISC, for just $1,500. Step 3, the main family business starts paying millions of dollars in commissions to this new company. And finally, step 4, all that commission money, over $5 million of it, gets funneled right into the son's Roth IRAs. And now it can grow there, completely tax-free, forever.
So, what was the magic trick? Why a DISC? Well, because of a very specific loophole. It turns out Congress gave DISCs some special treatment. They are specifically exempt from rules that would normally stop a family business from just funneling money into a retirement account like this. That was the key that unlocked the whole thing. They found 2 totally separate parts of the tax code that, when you put them together, created a result that I think we can safely say Congress probably never, ever intended.
And what's absolutely incredible is that the court agreed with them. The IRS fought this hard. They argued it was a total sham transaction, that it had no economic substance, just like those cases we just talked about. But the Sixth Circuit Court of Appeals, they looked at the literal words on the page and came to this stunning conclusion. They basically said, look, we don't really care what Congress meant to do. We only care about what the law actually says, and the words, as written, allow this. It was this huge win for a way of interpreting the law called textualism. And of course, this just opens up a massive question that gets to the very heart of how our legal system is supposed to work. I mean, if you follow the literal text of every single rule, but you end up with a result that seems to completely obliterate the entire purpose of other rules, like, say, the strict limits on how much you can put in a Roth IRA each year, have you really followed the law? Or have you just sort of weaponized its own complexity against itself? And here's the powerful counter-argument. Legal experts looking at this case say, well, hold on, you can't just read one rule in a vacuum. The tax code is a whole system, and a transaction can distort the meaning of that whole system when it cleverly uses 2 unrelated rules to completely cancel out a third one. The argument is that the rules for DISCs were never ever meant to just wipe out the rules for Roth IRAs.
And this really brings us to the bigger picture here, because the Summa Holdings case isn't just some weird one-off story. It's a perfect snapshot of this unending game that's constantly being played at the very heart of our financial and legal system.
The problem, or, the opportunity, depending on how you look at it, is just the sheer mind-numbing complexity of the system itself. I mean, the U.S. tax code is over 1 million words long, with millions more in regulations. When you have a rulebook that massive, it is almost guaranteed to have gaps, contradictions, and weird interactions that nobody ever saw coming. It basically creates a giant playground for creative interpretation.
So in the end, we're left with this fundamental fight that may never have a clear winner. On one side, you have the people who say we have to be able to rely on the clear written words of the law. Predictability is everything. And on the other side, you have people who argue that you have to interpret laws with an eye on their purpose, to stop outcomes that just make a mockery of the whole system.
And that leaves us with one last big question. When someone finds a combination of rules that leads to a result that nobody ever intended, like turning a few $1,000s into $5 million tax-free dollars, is that a mistake? Is it a bug in the code that just needs to be patched? Or is it a feature? An intended, or at least accepted, part of a system that rewards the people who have the resources to figure out its every last twist and turn? The answer to that question really defines the whole game.